Have you ever heard of someone who could see a financial storm coming before anyone else? Imagine being able to spot the cracks in the system while everyone else is still celebrating the boom. It takes a rare kind of vision, and even rarer courage, to stand apart from the crowd and sound the alarm before disaster strikes. Michael Burry is that man. He's not your typical Wall Street insider. In fact, his journey is as unconventional as his predictions. He's a doctor turned investor, made famous by The Big Short for predicting the 2008 housing crash. Burry's medical background gave him a unique perspective. He approached the market like a diagnosis, searching for symptoms others ignored. While everyone else missed the warning signs, Burry saw the market's weak foundation, risky loans destined to fail. He pored over thousands of pages of mortgage data, uncovering the truth hidden beneath layers of complexity. He stood alone, betting against the entire market, and was called crazy, until he was proven right. His conviction never wavered, even as the world doubted him. His courage and research made him a legend in finance. Burry's story is a testament to the power of independent thinking and relentless research. Today, when Burry speaks, the financial world listens. Investors, analysts, and even skeptics pay close attention to his every move. He's known for deep analysis and spotting hidden risks others overlook. His methods are meticulous, and his insights often run counter to popular opinion. Think of him as a financial detective, uncovering clues in plain sight. He pieces together information others dismiss, revealing patterns that change the game. When Burry shares a thought, it's more than an opinion. It's a signal. His warnings are never casual. They're grounded in evidence and careful study. His track record gives his words rare authority. Few can claim to have predicted a crisis of such magnitude and been vindicated so completely. Understanding his past is key to understanding why his latest message matters. History has shown that ignoring Burry can come at a great cost. Burry's history demands our attention. His insights have shaped the way many view risk and opportunity in the markets. He's not just another voice. He's the man who saw disaster before anyone else. His perspective is shaped by experience, skepticism, and a relentless search for truth. And now, he's warning us again. The question is, will we listen this time, or repeat the mistakes of the past? After nearly 2 years of complete silence, when many had begun to wonder if he would ever return to the public eye, Michael Burry made a sudden and unexpected return to social media on October 30th, 2025, sending ripples through the financial community. His message was brief, cryptic, and powerful. Just a few lines. Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play. The words seemed to echo with a sense of warning, and left everyone guessing about his true intentions. There were no charts, no graphs, no specifics. Just a riddle that seemed to hang in the air, challenging anyone who read it to decipher its meaning. Alongside the message, he posted a photo of Christian Bale, the actor who famously portrayed him in The Big Short. A subtle but unmistakable reminder of his legendary prediction before the 2008 financial crisis. The financial world took notice immediately. Traders, analysts, and investors everywhere stopped what they were doing to analyze his words. Burry's words suggested he sees a bubble forming now, but this time, he hinted that the smartest move might be to simply stay out and watch from the sidelines. He didn't name a stock, a sector, or even a market, fueling wild speculation and heated debates everywhere from Wall Street to social media. Was he warning about the entire market, a specific industry, or perhaps something even bigger and more systemic? By staying vague, Burry forced everyone to think for themselves, to question their own assumptions, and to look deeper into the markets. His message planted seeds of doubt and sparked urgent conversations in boardrooms, trading floors, and online forums alike. The photo connected his warning to his famous 2008 call, making it impossible for anyone to dismiss or ignore. This wasn't just a casual comment, it was a wake-up call, a signal that something big might be brewing beneath the surface. The mystery surrounding his warning only made it more powerful, as uncertainty spread through the markets. Investors everywhere began to question, what bubble is Burry seeing now? Is it tech, real estate, or something no one has noticed yet? His long silence had ended, and now the world was hanging on his every word, searching for clues in every sentence. The conversation about market risk had officially begun, and no one wanted to be caught off guard this time. Why does a single post from Burry cause such a stir? It's his track record. He's not just another analyst, He's the man who bet against the US housing market and won. His conviction was legendary, standing firm against the biggest banks. The Big Short made his story famous, turning him into a household name. Now, his audience includes everyone from Wall Street to everyday investors. When Burry speaks, people see it as a glimpse into the future. He's not selling anything, just sharing his observations. His 2008 call wasn't luck, it was deep research. That's why his words matter. People listen because he's been right before, when it counted most. They wonder, is he seeing something everyone else is missing again? His credibility is unmatched. When Burry talks, the world pays attention. Burry used the word bubble. But what exactly does that mean in the world of finance? It's a term that gets thrown around a lot, but it's important to understand what's really going on when people talk about a market bubble. A market bubble happens when prices of assets, like stocks, real estate, or even cryptocurrencies, soar far beyond their actual fundamental value. This surge is often driven by hype, speculation, and the fear of missing out, rather than by solid financial reasoning or real-world performance. It's a lot like blowing up a balloon. As excitement builds, more and more people jump in, inflating prices higher and higher. But just like a balloon, there's a limit to how much the market can stretch before it bursts. When the bubble finally bursts, prices can crash almost overnight. Those who bought in late, hoping to ride the wave, often end up losing the most. The 2008 housing crash is a textbook example. Home prices were pushed to unsustainable highs, fueled by risky loans and speculation. When reality set in, the market collapsed, leaving millions facing foreclosure and financial ruin. Today, some experts see similar warning signs, prices rising rapidly, especially in new tech sectors and trendy investments. The pattern of rapid growth and excitement is hard to ignore. The fear is that this excitement and optimism are pushing prices to levels that simply can't be justified by the underlying value of the companies or assets. Burry's warning taps into this growing anxiety among investors and analysts alike. He's suggesting that we might be at the point where the balloon is stretched dangerously thin, and just one shock could cause it all to unravel. It's a call for caution, a reminder to look past the hype and consider the real risks. Bubbles are driven by emotion, not by solid fundamentals. Greed and fear can take over, clouding judgment and leading to risky decisions. When everyone believes prices will rise forever, that's actually when the risk is at its highest. Overconfidence can be dangerous. Understanding how bubbles form and burst helps us see why Burry's message is so urgent. It's about recognizing the warning signs before it's too late. The lesson is clear. Be careful when markets look unstoppable, because that's often when they're most vulnerable to a sudden fall. When people ask what bubble Burry means, AI comes to mind. AI stocks have soared as investors chase the next big thing. The excitement is real. AI could transform everything. But the rush into AI stocks feels like past bubbles, like the dot-com era. Companies with AI in their name see valuations skyrocket, even without profits. The risk? Prices are driven by hype, not results. If AI companies don't deliver, stocks could crash. Burry's warning may be about this frenzy. Expectations are sky high. When everyone thinks something is a sure bet, danger is near. His message: look past the hype and question the real value. In the AI boom, one company stands out: NVIDIA. NVIDIA's chips power advanced AI, making its stock soar to a $5 trillion valuation. The company's rise is stunning, but its stock price has outpaced its profits. Investors are betting on endless growth, paying huge premiums. If growth slows or competition rises, NVIDIA's stock could tumble. Some analysts worry about circular financing, investing in customers who buy your products, making sales look stronger. There's no proof of wrongdoing, but high valuations make investors nervous. Burry hasn't named NVIDIA, but it's impossible to ignore in any AI bubble talk. NVIDIA's story is both a symbol of AI's promise and a warning about market excess. It shows how fast things can rise and how quickly they can fall. Even the best companies aren't immune to bubbles. Burry isn't a one-hit wonder. He's issued warnings and made bold bets for years. In 2021, he warned about meme stocks and crypto bubbles, seeing hype over fundamentals. He's also a contrarian, investing where others fear to tread. Recently, he bought into Chinese tech giants like Alibaba and Baidu when most investors were wary. Those bets paid off as Chinese tech rallied, showing Burry spots value, not just risk. He's not always right, but his big calls have shaped markets. Burry's history proves he can spot both bubbles and bargains. His actions reveal deep analysis and a willingness to go against the crowd. That's why his warnings matter. He's not just predicting doom, he's searching for opportunity. His track record gives context to every word he says. When Burry warns about a bubble, it's natural to worry about your money. But don't panic. A warning isn't a guarantee. For long-term investors, the key is to stay calm and review your strategy. Avoid emotional decisions. Don't sell everything out of fear. Use this moment to check your portfolio. Are you diversified? Don't put all your eggs in one basket, especially in hot sectors like AI. Diversification means mixing stocks, bonds, and other assets to reduce risk. Remember the difference between investing and speculating. Investing is about long-term growth and research. Speculating is chasing quick gains. Burry's warning targets speculators caught up in hype. For your money, focus on being an investor, not a gambler. Stick to your plan and know why you own each investment. If you're unsure, talk to a trusted financial advisor. The goal: build a strong foundation that weathers any storm. What should you do now? Be the CEO of your financial life. Educate yourself. Don't rely on headlines or tips. Learn the basics: diversification, risk, and long-term growth. Review your portfolio and rebalance if needed. If AI stocks have grown too large, consider trimming and diversifying. Rebalancing locks in profits and reduces risk. Keep investing consistently. Use dollar-cost averaging to smooth out market ups and downs. Don't try to time the market. Even experts rarely win that game. Remember your timeline. If you're investing for decades, short-term bubbles matter less. History shows markets recover over time. Patience and discipline are your best tools. Burry's warning is valuable, but not a command to abandon your goals. Stay smart, stay cautious, and stick to your plan.